Welcome, everybody. I just very briefly, I would like just to thank you very much for participating in today's webinar. We already had a similar webinar yesterday for English speakers and Asia. Well, we do believe that this is a relevant webinar, not only because its topic, the financing of disaster risk reduction, but also because it marks the launch of GNDR's new partnership with the Center for Disaster Protection. So it is an honor for our network to be able to work side by side with such a prestigious center, which is probably the global benchmark in DRR financing issues. The project we are embarking on together consists to meaningfully capture the frontline voices from local CSOs on disaster risk financing, along with leveraging learnings, identifying gaps and challenges from local context. So the proposed project aims to capture those local perspectives on those gaps and challenges in accessing disaster risk financing, but also how this could be addressed in advancing the Sendai framework. For us as a network, GNDR and its members, this is an unbeatable opportunity to come together as a network to discuss the localization of disaster financing, and we are very interested in hearing about your experiences, advice, recommendations for promoting and strengthening effective localized financing for disaster risk reductions. So hopefully you will have already seen the survey that we launched last week. Please do take a look and fill it in. Also, Jacqueline will be sharing the link in case you didn't get access to it. So Jacqueline will be sharing the link in our chat box during this webinar. But again, this is a great opportunity for you, our members, to share your experience, your expertise, and recommendations for financing DRR. Finally, I would like to just thank very much the CDP team, Ida, Chris, Blossom, Anna, Eloise, and the rest of course, the rest of the team for the partnership and for today's session, which will give an introductory session into financing for disasters, which we hope will set the scene for us as a network to explore how we can localize financing for disasters. Again, thank you very much for attending this very interesting webinar, and I hope it will meet your expectations. Over to you, Jacqueline.
Thank you so much, Marcos. A huge thank you to the CDP team for joining us today and for this wonderful partnership that we have. So maybe I would like to hand over to Blossom to share more about the center and the excellent work they do on disaster financing. Over to you, Blossom.
Thank you so much, Jacqueline, and thank you so much, Marcus, as well. Hello, everyone. It's so good to be here with you today. My name is Blossom Igbude, and I am a Policy Engagement Officer with the Center for Disaster Protection. And I have my colleagues here as well on the call, Chris Kidrell, who is our Head of Policy Engagement, and Ida Salil, who is a Risk Analyst at the Center, and will be leading the conversation today on pre-arranged financing for disasters. We're really excited to be partnering with GNDR on this very crucial project and with all of you as the network's members. Marcus has already talked a little about our partnership and the work we're planning to do together. And I would just like to take a few minutes now to just give you a bit more detail on our organization and the role that we play and our ambition for this work. And then after that, I will hand over to Ida for the bulk of the session, and she'll be providing an information introduction to some of the main issues, the topics, and the mechanisms that this joint work is focusing on, and just more detail into what the survey is digging into. And then we'll close with a quick run through from Chris on the main areas of the survey and what it focuses on, and a chance for you to ask any questions that you have before handing over to Marcus to round us off. So just a little bit about the Center for Disaster Protection. So the center is a technical and policy advisory organization focused on improving how the world plans and pays for disasters. So our focus is on ensuring that financing is proactive, it's evidence-based, and it reaches people before the disasters devastate lives. And specifically, we focus on prearranged disaster risk financing that delivers protection for vulnerable communities so that governments and other actors are better equipped and prepared to respond when the disasters strike. We combine rigorous research, technical advice, and global policy influence to shift international practice towards more effective, prearranged, and locally accessible financing. And this includes providing direct assistance to national governments and aid organizations as well on technical, training, and operational matters pertaining to financing for disaster risk. So we also produce thought-provoking pieces of evidence, such as our annual flagship State of Prearranged Finance reports, which we just produced towards the end of last year. And it's currently on our website if you want to take a look at that. Last year, also, we produced a comparative stock take of the primary instruments that we use in this field. So we work to influence the policy environment in various ways, such as through our active participation in the G20 and in the Financing for Development conference that happened last year in 2025. So just briefly about the project, we're excited to work with GNDR and its 2,000 plus members to draw directly on your thoughts and frontline experiences to understand what is and isn't working, where local actors are involved or excluded, and what barriers and opportunities exist as we carry on our work. Crucially, we aim to take these insights forward and to amplify local perspectives into international policy debates and into bilateral discussions and conversations with governments and agencies as well. So your insights are very crucial and important to us through this conversation and through the survey, and it will be a useful tool for us in protecting vulnerable communities through prearranged disaster risk financing. So I will now hand over to the able hands of Ida, who will lead today's session. Thank you so much for your time.
Thank you so much, Blossom. Just double checking my microphone was on. Great. Well, hello, bonjour, hola, or buenos dias, and ahlan, or sabah al khair. Should I say masa al khair? It's a pleasure to have to be part of this webinar and to move forward for the next part. From Blossom's given a great introduction already, and just to introduce myself, my name is Ida Salili, and I work at the Centre for Disaster Protection. I work in the training and advisory and training function, working as a risk finance capacity development expert as well as an analyst. So my background in the past, it's quite an exciting time being on this call because my background used to be in disaster response, but over the past 4 years, I've been working with the centre, and my role is focusing on disaster preparedness. It's an absolute pleasure to be on this call and to talk about this really important topic which we see in our development sector, which is disaster risk financing. Now, I'm going to start off by giving an overview of what we're going to be covering today, but I think a good place to start off with is disaster risk financing can be a very technical topic. And to give you an understanding of how what my work is when we're doing these trainings typically, is it would usually last about a whole day or a week's long of training, depending how technical and detailed we want it to be. So I'm really looking forward to today, this challenge where we have to condense this really challenging topic into a 45-minute session. So I've got my timer here, ready and making sure that I'm managing my time effectively. But I also want to start off by saying is today is going to be an overview talking about the holistic approach to disaster risk financing, because there's a lot of intricacies which we won't be tackling in depth today, and potentially we can explore trainings in the future sessions. And I'll also be sharing a reading list hopefully after these presentations to help give you a bit of background knowledge as well. But today we're going to be exploring disaster risk financing, and why disaster risk financing is needed, and what sort of frameworks, as well as the frameworks that exist with the financial tools and the mechanisms themselves that are involved in this process. And just to use this time to also mention is, whilst I'm going to be presenting this to you, feel free to put any questions that you might have into the questions in the chat box, and there will be some time towards the end for me and my colleagues on this call to help answer some of those questions. This will also be an interactive session. We will be using Slido, so please do make sure you've got your mobile phones ready at hand, because there'll be opportunities for you to get involved answering some questions. But I thought it's a good place for us to begin our session today, our webinar, with some of these words you can see on the screen. Now, these are some acronyms that we're probably hearing a lot in our daily lives. You often hear a lot of these words in the field that we work in, but also you're going to be hearing a lot of it from me today. So I thought it's a good place to start for us to all be on the same terms of what terminology we're using and what we're referencing throughout the session. So our main focus today is going to be on the first one, which is DRF, which is the acronym for disaster risk financing. I'll also be touching and talking about PAF, which is a short acronym for pre-arranged financing. And we'll talk about those in a bit more detail in the next slides. But let's start off with the next ones, which we've got disaster risk reduction, DRR, and DRM, disaster risk management. These two come up quite often. And so let's just go over throughout the session, what do I mean by DRR and DRM? So by disaster risk management, that is the overarching approach. So this is the application of the policies and strategies to prevent new disaster risk, or perhaps reducing the existing risks that exist and managing that residual risk as well. So disaster risk management is about strengthening resilience and making sure we're doing as much as we can to reduce disasters losses overall. And within this disaster risk management, we have disaster risk reduction. So disaster risk reduction is a policy objective. So it's focusing on preventing new risks and reducing the existing ones. And its goals are usually captured in perhaps national or local disaster risk reduction strategies and plans. So if we think about it in the sense of disaster risk management is a big umbrella, and disaster risk reduction is a goal that comes under that umbrella. And disaster risk financing and pre-arranged financing, which we're going to look at in the next few slides, these are the financial tools that help us achieve all of these goals by making sure we've got those resources ready when we need them, which is a key part to pretty much, which I'm sure a key part to most of the work that we all come across. So we're going to come back to disaster risk financing and pre-arranged financing in a moment, but I just want to make sure we're clear on how these pieces all fit together before we dive in deeper. And I actually have a question for all of you. I want to ask you, so we're now going to go to Slido, a question I have for you is, in using one or two words, what does your organisation most need financing for when a disaster strikes? So thinking about it and perhaps a local context, I want you to think about, it could be absolutely anything, just to share one or two words. It could be response, it could be relief, infrastructure, cash transfers, early action, whatever comes to your mind for your specific context, whether through your organisations, for your country. I'm going to give you about a minute or so. See if you can come onto Slido. You can scan that barcode on your mobile phone. It should take you directly to the question. Or you can go onto slido.com and put in that code and it should come up. Now, this is really important, this exercise, because we did this yesterday with the Asia group, and it just goes to show the different diversity of needs that come with disaster, what type of financial needs. I think people might have inserted in Oh, I didn't consider perhaps language-wise. Maybe I need to think back to my school French and Spanish. But please feel free to submit your answers in. But it just goes to show the diversity of different needs that come with different types of what needs are for disaster responses. And we're going to come to it later on as to why that's really essential and really important. So we've got anticipatory actions, great. So this is thinking about early actions. We're going to come across anticipatory action in a few seconds. Supporting finance. I'm going to, let's see what some of these are saying. Support for finance, anticipatory actions, response, capacity building. Feel free to put these in French and Spanish if I still remember them from my school. I remember the apoyo was support in Spanish. All right, fantastic. So it's really interesting seeing how anticipatory action seems to be a key topic that's coming up. What do we need most financing for when the disaster strikes? Anticipatory action. Really interesting. Access to funding. Funding mobilization. This is also an important one. The response. Meeting the health needs of victims, fantastic. So putting people at the forefront. Is the support going to the communities that are most vulnerable and need it the most? Great. Where are the donors? Great questions. The key actors. So perhaps it's having a collaborative approach, but financing by having all the stakeholders involved. Aplicar normas, humanitarians. Normas. So it's interesting seeing the range of responses that are here. And it's, I would say to you, as the session's going on, keep thinking about this and connecting it back to your context. Right, we're going to be moving on now to the next slide. So as I mentioned, we're going to be coming to disaster risk financing, pre-arranged financing in the next few slides, and here we are. So this is our definition of disaster risk financing. Disaster risk financing is essentially covering a system of whether it's budgetary and financial mechanisms to credibly pay for a specific risk. And this is usually arranged before a potential shock. So this can include paying to prevent and even to reduce disaster risk, as well as preparing for and responding to disasters. So this is our definition of disaster risk financing, and I think the diagram which I'm about to show you really represents that in a good way. So I'm just going to show you this, and I would like to put your attention to this grey box. So we spoke about disaster risk financing. What does pre-arranged financing actually mean? So we're going to break this down. If we think about this crisis timeline, if we have a look at this white line here, before a disaster strikes, on this crisis timeline, we have investments in preparedness and disaster risk reduction. Then, when a crisis approaches, we have forecast-based financing. So this is just before the crisis happens. This is what we all are quite familiar with. We saw in the previous slide, lots of people are already aware of the type of financing of anticipatory action. So this is where we would put anticipatory action. It can be triggered by things like a forecast, it could be rainfall levels, wind speed, and then that is when that pre-arranged financing can come into it. And then we have this orange box. Now this orange box, it could either be before the crisis or it can either be after the crisis. And what this is pre-arranged financing is money that has been approved in advance of a crisis, and it's guaranteed to be released from a simple implicator, a specific implementer. So what I mean by that, it's triggered when an event occurs based on conditions that you set out previously. So it can be quite similar to anticipatory action in the sense of you're using the same triggers. It could be rainfall levels. It can also be a trigger where you're declaring an emergency. So the triggers can be quite different, but you have set those conditions in before the crisis has happened. Now, why is this really important? Because instead of waiting for a disaster to happen and scrambling for funds, which can usually take weeks and months, this approach where we've got pre-arranged financing can ensure that money is available quickly and also predictably. So we're not looking last minute, trying to gather as much funds as we can at the time where it's most needed. So this makes the response, it makes it faster, less costly as well at times, and less fragmented. So it shifts us from being reactive to proactive. Now, this is pre-arranged financing. Where's disaster risk financing come into it? This grey box is disaster risk financing. So, disaster risk financing, according to our definition, includes financing to support disaster risk reduction. And also in our definition, pre-arranged financing mechanisms also comes in disaster risk financing. So we're thinking as disaster risk financing is that grey box. Okay? And some people ask us questions about pre-arranged financing, and people always assume pre-arranged financing is just insurance, but it's not. Pre-arranging financing can be a broader concept. It can be a range of different instruments, which we will look into in the next couple of slides. We can have examples of contingent loans. We've got examples of catastrophe bonds, parametric insurance. These are all tools that work together to make sure that financial needs are supported before a crisis. And so governments and partners can really act decisively in making sure they're protecting lives and livelihoods. And with that in mind, I'm going to come on to the next slide. So something that's really important about the work that we do at the centre is we have a really great evidence team. And when it comes to pre-arranged financing, for the past 3 years, our evidence team has been producing an annual report. And this goal is to build up a picture of different trends and developments that have been happening in this space. So these reports have done much more than just track progress, actually. They've actually shaped these policy dialogues, which Blossom had given in her introduction. So for example, we've seen a lot of pre-arranged financing, PAF, the acronym, that's been used in a lot of global initiatives. We see examples in Bridgetown 3.0, in the Seville Platform for Action. And so it's really interesting seeing pre-arranged financing really being at the forefront of the global dialogue. So I really highly recommend, I'll show you where you can find these reports, but you can find they're on our website, and they really are really interesting to read, and they provide a really valuable insight into where the sector is heading and how financial strategies are evolving. Disaster risk financing is evolving sector as technology is developing. We're seeing a lot of new developments being done in our sector. So that's why every year these reports are actually quite exciting. Now, in our analysis, we can see some really interesting patterns that are emerging. Some of the trends can help us inform whether it's national strategies or international frameworks. But PAF isn't just a technical concept, it's also influencing global conversations about resilience and climate finance. So just talking about the recent report that we did, so the 2024 the data that had been published is in 2024, pre-arranged financing reached its all-time high of $9.4 billion. Now, we think that's a significant milestone, and we can see how much attention this area is getting globally. But it's important to caveat here that this financing is not evenly distributed globally. It's not evenly distributed across countries. And many of the most climate vulnerable countries still do not have pre-arranged financing put in place. So while the overall figure of 9.4 billion sounds exciting, unfortunately it's not the reality, and it's on the ground it's a lot more uneven than that. And the last point is the evolving landscape. So new instruments, as I mentioned, disaster risk financing is an exciting sector to be in because we've got new mechanisms which are emerging all the time. So things like anticipatory action, innovative insurance models, even catastrophe bonds. In the future, reporting these will need to be reflected in these changes. But the key takeaway is that as technology is getting better and more data we can get, the more innovative this field can also be. So there's a lot of progress that's been made, but there's also a long way for us to go to make this even better, to make sure that financing reaches those people who need it the most and that we're keeping pace with innovation. So I've spoken a lot about pre-arranged financing, but why do we think pre-arranging financing is a good thing? So, we think that pre-arranged financing can make a really big difference. Today, we can model future risk with greater precision thanks to the advancements of technology, data, new ways of working, but we still wait to react after a disaster. Now, this leaves vulnerable countries and communities really exposed to escalating costs and are really dependent on reactive, fragmented post-crisis financing. We have a really good example of this for us in the United Kingdom. We had this with COVID-19, where we were left after the disaster strikes to really try to find some financial mechanisms to help support us funding this disaster. So it's really waiting to be reactive. Now, pre-arranging financing has the potential to really better protect communities and really preserve livelihoods and shift the leadership mindset from reaction all the way to readiness. So it results to a more proactive approach to manage the risk and provide support more quickly when it's needed, and again targeting the communities that are going to be hardest hit by these shocks. So what does good disaster risk financing look like? Now, this is where things are going to start to get technical. So if you haven't already, please do make sure to go to have your sip of water, because now it's where you need to be really focusing and paying attention. So when it comes to disaster risk financing, we use this framework. This is a framework that we use actually for our quality assurance work that we do. When we're assessing instruments, we use this model to really help us with the analytical work that we do. So when you're thinking about good disaster risk financing, it's a holistic approach. It's thinking about the context, the money out, the money in, and the processes. So what do I mean by all of these? Let's go through these one by one. The context. What are the underlying risks, need, and wider factors to consider when developing disaster risk financing based approaches? So this is the context. The context is going to be incredibly important. What are the hazards? What are the risks? What are the needs? What are some things that we need to consider when we're looking at our financial means? Do we have localized governments? Do we have different types of climate data? We have lack of climate data. What kind of needs do we need to think about? Vulnerabilities of community. What's our poverty thresholds? What is our debts? Our debt crisis. How much are we paying in debt that we need to think about when it comes to budgetary mechanisms? So these are just some ideas of a country's context is really important to what your disaster risk financing strategy would look like. It would tailor and be bespoke for it. Something that we need to be mindful of is when it comes to the work that we are in international development, is that what works for one country is not going to work for another country. In particular, what works for one country might not work for its neighbor. Even if they're living in the same continent, they can have completely different country context, completely different country profiles. So everything is context driven, and we can see the context surrounds the entire approach. When we're thinking of money in, this is where people get really excited. They're thinking about what are the instruments, what are the mechanisms that we're going to be putting in place to get the sort of the money that we need in order for response and recovery. Is that going to be an insurance product, anticipatory action? What are the money in options that we have? But the reason why money in here is attached here to the money out, and this is why this webinar is very important, because most of you sit into this important part of disaster risk financing, which is the money out. What are the delivery systems? What are the plans that have been put in place in order to make sure that that money reaches positive impact for those people that are feeling the impacts of this disaster? What are the delivery systems? How is that, once you've got the money, what's the contingency plan that you have in place in order to tell you where that money needs to go to in order for you to act rapidly in a timely manner and making sure you've got the right amount of money at the right time? This is where money out comes into it. So money out is very important, and you cannot have money in, you cannot have money coming to you without money out, without having a plan of what you're going to be doing with that money once you receive it. So that's why we put these two together. And embedded within the money in the money out is the process. So these are about the key practical considerations. This can be project implementation, processes, contingency, monitoring, evaluation, and learning. What are things that we can do even better? So it all needs to be embedded within process as well. So this is just to show you, a slide to show you how holistic the approach of disaster risk financing actually is, and how everybody has a role to play in disaster risk financing. So, as I mentioned, this is where it's going to get technical. I've got 23 minutes left, and this is where we got to be making sure that we're paying as much attention as possible. So now we're going to be going through, I think it's about 6 slides, but this is where it's going to get very technical. We're going to look at the different types of instruments that exist in disaster risk financing. And just want to say again, if you've got any questions on these instruments, feel free to put them in the chat, and towards the end we'll have some time to answer those. Now, when we're looking at instruments, we have 3 different categories. We have risk reduction, we have risk retention, and we have risk transfer. Now, when it comes to risk reduction, it's all about lowering the underlying risk before the disaster happens. So think about it as investing upfront, strengthening infrastructure, improving systems, and making sure we're reducing vulnerability so that the impact of the disasters gets smaller and smaller. So these are different types of, again, we'll go into some of these instruments in a bit more detail, but we're not going to go through risk reduction instruments, but just to give you an idea of risk reduction instruments that exist in order for you to reduce the risks. Okay? So this could be like putting investments, securing financial support in order to build flood walls. That's an example of financial mechanisms in order to support with risk reduction. Let's move on to the next one now, risk retention. Now, what do we mean by risk retention? Risk retention means you are keeping the risk on your own balance sheet, but you're planning for it. So in other words, a good example of a budgetary instrument, it can be a contingency fund, it could be a reserve fund that I'm putting aside to support if a drought is coming. Now, this is an example of, a government or an organization that will accept the level of risk, and it will remain and set aside resources and arrangements to deal with it as quickly as and when needed. It's quite a flexible example, this the reserve fund, but it's an example of you're retaining the risk. The risk stays on your own balance sheet. Whereas the next one, which is risk transfer is when you're shifting part of that risk onto a third party, because potentially the losses are going to be too large for you to manage alone. So you typically use these for quite rare, high impact events where the financial shock could really overwhelm your national budgets. So when something is going to be very expensive and it doesn't happen quite often, risk transfer is usually an instrument of risk transfer would probably be most appropriate. Whereas risk retention, if it's something that happens quite regularly and you can manage that and it's going to come from your own budgets, then that's what we call risk retention instruments. So in simple terms, when we're looking at all 3 of them, you can reduce what you can, retain what you can manage, and transfer what you can't afford to carry alone. And that comes in quite nicely to the next slide. So this is a generic table that we've got up here in front of you. It's not tied to one specific country. Again, this is quite a generic model that we use to think about all the different types of options that are available. Now, the key here is not to memorize every single thing on this table, but it's just to understand some of the technical features behind the different class of instruments, because that helps us to figure out how and when they might be applied in those different contexts. Now, the table is organized in 2 important dimensions. So the first one is when is the financing arranged? So we can see in this category, we've got pre-planned. So this is pre-planned, it's before a disaster. Before a disaster happens, these are some instruments that you would need these are some instruments that you can access before the disaster strikes. And these are also called ex ante. This is using the Latin vocabulary. This is the terminology that's used by the World Bank, ex ante. So these are all the instruments that are available before the disaster strikes. Now, the bottom here, this is unplanned, ex post. We're going to come to that later on if we've got time. But these are some instruments that happen after the disaster. So this line is separating before and after. Now, another thing to mention here is this top part of this table. Now, this is about who holds the risks, all the way from the individual level to communities and businesses, all the way up to governments and international actors. Another point I'm going to mention here is that instruments could be budgetary or financial. So budgetary is I gave you the example of emergency budget reallocation, a reserve fund a government puts aside to support with financing the disaster. And you also have financial, so financial instruments. These are offered on a financially offered at the international scale. And that's what we're going to be focusing on in the next couple of slides. We're focusing at that international scale instruments that are available. Again, we can explore all the others perhaps in future sessions. Again, I said we're condensing a 5-day training into a 35-minute slot. So it's just to show you here, and also to mention that we've been mentioning now about risk transfer and risk retention. So this is another part of this table where it shows you these are the instruments where we're transferring the risk, and these are the instruments where we're retaining the risk. And these slides, I think, would have been sent to you, or they will be sent to you. So again, you can have a look at those in a bit more detail in your own time. So these instruments are essentially allowing you for faster, more planned, more reliable resources and can reduce the long-term costs of disasters by preventing delays in the action itself. So we will start with, with that framing in mind, let's now begin the deep dive and see how they all fit in with the comprehensive disaster risk financing strategies. And we come on to here. So the Centre for Disaster Protection, as Blossom had mentioned already, we did a stock take of different pre-arranged financing instruments that are available from different international financial institutions, especially some MDBs and regional risk pools. And it just is a really great way in this diagram for you to have a look at. And we're going to go into those in a bit more detail. But these are internationally supported pre-arranged financing instruments available. And the first one is contingent disaster loans in grants. Now, these are prepared and approved in advance of an event, so they can be accessed quickly after a disaster, providing that a certain pre-arranged condition or triggers have been met. So the idea is that governments can access money, can access liquidity without going through lengthy negotiations during a crisis. So institutions that offer contingent disaster grants are Asian Development Bank, the Inter-American Development Bank, the World Bank. They offer these types of instruments. For a contingent loan, we've got an example that you probably are familiar with, a CAT DDO. And typically this is, again, this is country level, so sovereign level. At a government, you can access a CAT DDO. And what happens is that a trigger would be a formal declaration of a state of emergency. Now, that might sound quite straightforward, where you declare a state of emergency and you can get access to money, access to the liquidity from the loan that you've got. But this can be quite politically complex. This is what we've noticed. It can be quite complex, where you've got different stakeholders that might have a different view of when and how to declare an emergency. Also, something to note about this is that once it's triggered, the payout is designed to be fast. So I think for a CAT DDO, it's supposed to be 48 hours, which can be a huge advantage compared to other sorts of financial financing, which might take longer. And again, context matters because the timing might be really important. If money is coming too late, the opportunity for early action is lost. So we've seen that countries that have CAT DDO, also to note here, timeliness is really important, whether to assess if this is an appropriate instrument or not. Something to also note is that typically with something like a CAT DDO, You have to commit to policy reforms and actions designed to strengthen disaster risk capacity management and resilience, which are monitored by the World Bank. So there are some conditions when you do want to access these instruments. If you're getting it from specific development partners, you need to have a criteria list and like a tick box exercise. And if you can't tick those boxes, then you won't be able to access it. Now, why is this important to mention for risk retention? So we get this question about a loan or grant. Why is that risk retention? Well, the important note here is that it's a loan, so you have to pay it back. So countries really need to think about whether a budgetary mechanism is there a mechanism put in place to help you repay this back. Now, and if this planning isn't done up front, it can really create fiscal stress later on. So thinking about how are you going to pay for this? Is this money ring fenced? What do I mean by ring fence is that are you only allowed to use this pot of money to support with paying with your contingent loan that you got? Or is it going to get absorbed into other budgets? So, for example, if you've got the money set aside to support with contingent grants, paying back your CAT DDO, or is it that, let's say, a different department in your country needs to access money really quickly, then you're going to have to give that money back to a different department because you can move around from different budgets. So thinking about, is that money budget fenced as well? Ring fence, that's the word for it. And also, are you replenishing the funds? So once you've started paying off some of the, let's say, the fees for the contingent loan, have you now started to put money back into that budgetary mechanism so you can continue paying it back? So it's all this financial process that can be quite technical, but when it comes to risk retention, these things are very important. Thinking about how are you paying for this? Is the money ring fenced? Is it going to be used for disaster response? And how can you make sure that there's going to be money available for you for the next time as well that you need to make this payment? Now, the next one for our risk retention mechanism is climate resilient debt clauses. So these are something that's quite new and emerging, and these are legal clauses that are in debt contracts that allows a country to temporarily suspend debt payments if a disaster occurs. And certain prearranged conditions have to be met. Again, similar to the loan that we saw, there are conditions that you need to make sure that you're applying with. Now, why does this matter? Now, think about it. When a major disaster strikes, governments can face huge financial burdens. And responding to a crisis while also making sure that you're paying back the debt can cause a lot of stress at that time. So these clauses are there to support with giving you breathing space, so freeing up resources for you to go in and sort and give that emergency response without having to go into those obligations that you need to be paying back the debt. So it's important to note here that not to get confused with debt forgiveness. These are deferred payments, so they still have to be repaid within an agreed certain period. But there's a flexibility here, which can help in a big difference when there's an aftermath of a disaster. And some organizations that offer this are institutions like the Inter-American Development Bank, the World Bank have started incorporating these clauses into their lending frameworks. And we expect to see more of these as countries look for better ways to build resilience into their financial systems. So we're now going to take a bit of a breather from risk retention before we go into transfer. And I would like to ask you all a question. So when we're thinking about those risk retention, I would like to ask you if you had to rank the barriers of these instruments, of the risk retention instruments, from the most serious to the least serious in your specific context, what would it be? Have you noticed that access to money for these, so it could be in your context, it could be the financial instruments that you saw, or it can be a reserve fund. Perhaps your governments and your countries have a reserve fund to support with drought, to support with earthquakes, floods. How are you able to access those funds? Is the issue that it's slow approvals, so the money comes in, it takes a while for it to be approved and sent? Is it that there's a lack of clear release triggers? So is the issue here that you don't know what you need to do in order to access the money? Does there need to be something like somebody has to declare it that they need there's a drought and we need to have the access to the funds to support the drought? Or is it something that's parametric? So what do I mean by parametric? Is it something that's been analyzed through soil moisture, something that's to do with the temperature? If the temperature reaches 40 degrees, then we can able to get access to financing. So is it to do with the actual trigger itself? Is it to do with the funds not being ring fenced? That goes back to the example of there's a reserve that's been put aside, but anybody can use the money that's inside that fund for other departments that might need it. Is the money not ring fenced? Does it get diverted? Again, we saw an example of this in the UK with COVID, is that what happened was is that lots of money had to be taken out from different budgets to help support with the COVID response. Replenishment plan. So what do I mean by replenishment plan? Is there a plan that's been put in place for you to top up that money once you've used it? So if there's been a drought and you've used the money to support with the response for the drought, have you then thought about ways to put money back into it for the next time the drought happens? Have you made a replenishment plan? So if you had to think about your context and you had to rank of what would be the barriers when it comes to these risk retention instruments from the most serious to the least serious in your context, what would they be? I'll give you about a minute or so to have a go at finishing off this ranking. Right, it looks like the most popular answer here is slow approvals. So it might, this is an interesting one, something that we see a lot in our line of work is when we're doing these sorts of assessments, is that you're right, slow approval seems to be a big barrier that comes with risk retention, being able to access the money at the right time. Timeliness is really important, and as we mentioned before with some instruments, a difference between getting money to come within a week to a day to an hour can make the biggest difference. So slow approvals is definitely an issue that we see a lot in this space. But I'll keep this poll open, and perhaps if you've got time for the rest of you that are on this call, have a go at continuing to do this because we're interested as well to hear your perspective coming from your organisations, what you think is the biggest barrier. So please, if this is open, please continue to rank those. We'll be interested to see those responses. Okay, I've got 5 minutes left, and I think I've got a few more slides left. Now we're going to move on to the risk transfer instruments. So starting off with insurance. Now, on a sovereign level, this is what on a country level, what kind of risk transfer instruments can countries access? This is what we call risk pools. And risk pools, it's in the word itself, risk pools. And this is when countries come together to pool their risks and to purchase insurance collectively. And a portion of that risk is retained through their reserves, while the rest is transferred to the market. So there is a cheaper access to insurance, and there is greater ability for them to mobilize donor funding to help support with the premium financing as well, to support pay for the premiums for the insurance product. Also, the good thing with these risk pools is that there's also design and validation products, which means that countries can really facilitate on joint learnings and they can really work on improving the product design itself. And also, each country would have a technical working group that support with collecting data to give you the most appropriate product for or model for the disaster. So just to note as well, an issue that we see in our line of work is data, getting data to really support you with accessing international finance. You need data to be able to access international finance. So risk pools, the benefit that they have is they've got these technical working groups that support on the technical side to it. So where there's some capacity gaps, they can fill those in that manner. Now, why do this? So when we've got large scale disasters, why would insurance be something that's quite attractive? We spoke about this at the beginning of different scale of disasters, different types of instruments would be appropriate. So when you've got a large scale disaster, it can be really overwhelming on a national budget, on the government budget. So by transferring part of that risk to an insurer or to global markets, countries can access money quickly If there's the trigger has been met. So again, the trigger that we spoke about, typically for insurance, would be a parametric trigger. So it'd be a rainfall, it would be the level of rainfall, it would be the wind speed, it would be the earthquake magnitude, the number of the earthquake magnitude. Again, for drought, it would be the moisture. And once that trigger is met, you can be able to access those funds. And these arrangements are often operated through these risk pools, and in each continent, there are risk pools. So there are four risk pools that exist. In Africa is the African Risk Capacity, known as ARC. So that's the one in Africa. In the Caribbean is CCRIF. In the Pacific is PCRIC. And in Southeast Asia is SeaDrift. So there are currently four risk pools that exist. That what happens is the pooling a risk across multiple countries within the region that help lower the cost and also improve the efficiency as well. But again, there are some challenges to keep in mind. When we're talking about insurance, it can be quite complex. Those triggers are something that can be very controversial. So the triggers that I spoke about, the earthquake magnitude, the wind speed, making sure that triggers are clear and making sure they're objective. So it's not to be taking a specific side. It's really important. Otherwise, there can be a lot of disputes about delay of payouts. Even with parametric triggers, which you think are objective because it's not going to be something that's political, because it's something that's assessed through geophysics. Unfortunately, there could be something called basis risk. And basis risk is essentially when the payout doesn't match what's actually happening and doesn't match the actual loss. So, for example, if there's a drought and according to the model, the soil moisture hasn't hit the number in order for you to get access to the financial means. So technically a drought hasn't happened, but yet you can see with your eyes or through the experiences of the community that there is in fact a drought. And so what happens is this is what we call basis risk. So what you see is not quite similar to what the computer is telling you. Now, whilst these payouts for insurance can be quite fast compared to different types of traditional aid, we still need these strong delivery systems to ensure those funds are reached to those communities that are affected the most. So again, this is why all of you on this call are so important. It's the money out. Having the money as one side of the picture, you need to be working collaboratively to be thinking about when the money comes in and when it's come at the right time, what are you going to be doing with it? And the last instrument that I've got, and I've got 2 minutes left, is catastrophe bonds. So these are catastrophe bonds, cat bonds for short. Despite the names, they're quite different to regular government bonds. In fact, they work more similar to insurance. So the basic idea is a country called the sponsor will issue a cat bond to the investors in the capital markets. Investors put in money and in return they earn interest, just like with a normal bond. But the twist here is if there's a major disaster happens and the certain triggers of the needs have been agreed, the conditions, and that trigger is met, what happens is the investors will lose some or all of their money, and that money is used to help the country respond to the disaster. So cat bonds transfer disaster risk from the governments to the investors. But these bonds can be incredibly complex to set up. And you have some institutions like the World Bank, which often issues them on behalf of countries due to credit ratings. And also data. Data is a big issue. If you don't have that much data, then you can have private insurance companies that are giving you a very expensive quote for it. So most examples so far are, in Latin America. There's one notable case as well, also in the Caribbean. We've got Jamaica. Jamaica's current cat bond, I think, provides $150 million of dollars of insurance coverage against tropical cyclones. So cat bonds are something. It's an innovative way to bring capital market into disaster financing, but they require careful design and clear triggers as well. Again, I can go into a whole training on a whole webinar just on cat bonds or just on insurance. But just to give you an idea of, again, this is just a generic overview. Well, that's my alarm telling me that I'm over time, of what these different instruments are. So, some really key considerations to think about is we often get the question of we've got risk retention, risk transfer, and risk reduction instruments. Now, how do we get the right balance between those three different strategies? How can a government decide, or which portion should they be reducing the risk, retaining, or transferring? And what kind of role do we all have to play in this strategy? Well, risk reduction is more effective for strategies which are low to medium sized losses, whereas risk financing, like retention and transfer, are more generally more effective to medium to extreme losses. So things like earthquakes, these are things where you're going to be looking at different types of instruments. And even if large shares of risk is effectively reduced, transferred, or retained, some extreme risks are likely to remain unprotected. So you need to make sure that there is some solution to help with that funding gap. Now, while these are general rules of thumbs, it's all about getting the right balance between it. It's all context specific, as I showed you that diagram. It's all to do with the context. So that's why the considerations on the slide are really important. These questions that you can see here. So those are some examples of some risk pre-arranged financing mechanisms that are available. I'll just quickly talk about after a disaster as well. There are some options for after a disaster, what types of instruments there are. And we can see here some examples could be reallocating your budget reallocation. Again, COVID-19 was an example I gave for this. You took out money from Department of Education and you would put that into the Ministry of Health to support fund for COVID. So we can see budget reallocation, but this can really have lasting damage. Again, we see this example where to this day, 7 years since COVID, we're still feeling the impacts that some sectors have, whether it's education, transport, education, well, I said education, different sectors are still feeling the impacts where all their money was taken away and put into to support COVID at the time. So it can have a long-lasting impact. And also it might be quite limited as well, something to think about. When you're cutting back on discretionary spending, this can sometimes be quite limited. You might not have cut back on certain things. The next one is borrowing and asset sales. There might be very few willing to lend. You might be able to borrow, but you might be quite limited in your options. There are tax increases, which are as an option for governments, not quite at organizational level. But remember, this is not immediate access to financial support. This can take a long time in order for you to get support from that, and it can be quite politically insensitive. So governments don't tend to like the option of tax increases. Another one is humanitarian aid. So it's asking for humanitarian aid support, but as we've seen in our sector, there's been huge funding cuts in the last few years. So it's not guaranteed that you'll get it. So you can see that there are different types of instruments that exist, and each instrument, you must be thinking back to the question of what does good disaster risk financing look like? Do we have the money out systems in order for us to access these instruments? What is the context that makes these more appropriate to us? And do we have the right process that's been put in place? And just to say, there is no such thing as a best instrument. Which one of these is the best? Is the insurance is the best? Is the climate resilient debt clause the best? Which one's the best? The answer is that none of them are the best. It's not about what should one specific country be using. Each tool, whether it's insurance, contingent credit, has its strengths and its limitations. And the key here is finding the right mix that will align with what your specific country's risk profile, the response capacity, and also the financial landscape. What works in one context might not work in another. So you have to be quite flexible, and it has to be tailored to the strategy that's been there. So the goal isn't to choose one perfect instrument, and it's all about thinking of it as like a toolbox. If you've got a toolbox, each specific tool in a toolbox has a purpose, but not one single tool can do absolutely everything. So that's why disaster risk financing is about matching that specific right tool to the right layer of risk. And the answer is that you can combine some of those instruments together. It's not one single instrument is the best, but it's about a combination of the instruments. The truth is that there isn't one, and it's about mixing the different retention, risk transfer instruments. There could also be domestically financing tools like the budgets that we spoke about, contingency reserves, disaster funds. This is what we call risk layering. So you're layering on the different instruments because your instruments are suited to the different types of risk. So, for example, if you've got drought, which can be small to medium, it could be more frequent and it can be retained through your own resources. Whilst you've got earthquake, you've got an issue of earthquakes as well in your country. You've got to be thinking about risk transfer. So you can have a risk retention and a risk transfer as well as risk reduction instruments available to you. It's about layering it on together, combining, it's the combination of disaster risk finance, which makes disaster risk financing so effective. It's about building resilience and not relying on one single solution or one single instrument. And I'm going to stop with this picture for you, is that when we're looking at the layering of instruments, when we're talking about the right strategy, it's thinking about these 7 keys to unlocking good disaster risk financing. Focusing on poverty, focusing on making sure it's timely. Is it offering you good value? Some of those instruments are very expensive. Can we afford it? Providing a trusted guarantee. Do we trust the provider? Is there an issue of basis risk that potentially might come from it? Making sure we're creating power for people at risk. And are we making sure we're improving constantly? We have more access to data. We should be looking at what else could be innovative ways to be accessing disaster risk financing. So this is all showing you the holistic approach when it comes to disaster risk financing. And I'm going to be stopping here today, and just wanted to say that I've enjoyed delivering these webinars because, again, I'm quite interested in the questions that come our way. If you've got any further questions, or if we haven't got time to get through them today because maybe I've spoken for too long of a time, here's our email address at info@disasterprotection.org, and feel free to direct any specific questions you have for us. I've also put here our LinkedIn's as well. If you want to scan the QR codes that go to our LinkedIn, you can access us individually and you can ask us specific questions that you might have. And also, we've got on our website, we've got a publication center where all our different reports and publications have been put there. And I really would suggest you, if you've got a specific topic about a specific instrument or the stock take that we did of the different instruments, or looking at quality assurance, so the puffin that we saw with the context, money in, money out processes, they're all available to you on this website. So please, if you feel free to have a look at those. They are available in different languages. We have them translated into Spanish, French, and Arabic, so you can have a look. And if you've got any questions, you can direct them our way. But before I hand over to my wonderful colleague, Chris, I would like to end it off with going back and asking you a question. And that is, what would be your top recommendation to decision makers, so that's governments to donors, on how we can improve how we plan and pay for disasters? I'm going to leave this question here for you, so that you can access and you can put your inputs here. And also, whilst Chris, whilst I put the slide up for you as well, I'm going to have this open, so please feel free to continue to add your responses here. But thank you so much for being patient with me. I went a bit over time, but I'm going to hand back now to Chris, my colleague.
That's brilliant. Thank you, Ida. And hi, everybody. Thanks for your time today. I'm Chris Kidgel, so I'm Head of Policy Engagement at the Centre for Disaster Protection, and delighted to be working with GNDR and with all of you on this piece of work. We do have an additional slide from me. I'm going to suggest that Ida perhaps leaves the screen that's up on. That's possibly more useful in the short term. The point I just wanted to make briefly to all of you is just to return to what Marcos was saying at the start of this session about the survey, and in part that might respond to some of the questions that have been coming in. So some of these areas are new to all of us, and actually historically a lot of what Ida's been talking about, these big instruments, prearranged funding, disaster risk finance, tend to be done at a government level and at a big international institutions level. I think we all believe that there's an important role for national and local civil society organizations in this. And what we're trying to do through this survey is to draw on your expertise, your insights, and your questions to help us better understand what that looks like. So some of that is around you as last mile actors, and it might be that you are receiving funding from international NGOs or from governments to actually provide that final response, and how is that working in practice? But I think there's also a role in terms of what CSOs do in helping governments to understand where vulnerable communities are, what they might need ahead of a disaster, to help with targeting, to help with developing triggers, to help with accountability and transparency in how funds are used. So the questions in the survey are really designed to try and understand some of that from you. How is this working in practice? And if it isn't, what would you like to see change? What can we call on to do differently? So that's part of it in terms of trying to bring some of those messages up to decision makers at national and international level, but also to share learnings between different organizations, that if some of you are finding things that do work for you, what lessons can perhaps be shared with others in terms of accessing that funding. So the survey really is important, and we do want to use it quite practically. This is the start of a process, and I think we all see it as that, and it will be very dependent on your involvement and your expertise. So looking forward to working together on that. I'm going to take just a few more minutes, and Jacqueline or Marcos, stop me whenever we need to. My apologies to the translators. I have been a lot of questions appearing, predominantly in French, I think, but a mix. I have been pasting into Google, so the translations are probably pretty poor compared to what you're doing, but let me try and answer briefly a few of these, and apologies also to the askers if I'm getting pronunciations or orderings of names wrong. But there were a few in there. I will try and answer all of them briefly. As Ida says, do come back to us, and we will think about how we can follow up on some of this. Couple of quick pieces. So Bibream John, you asked multiple questions. Let me try and answer a couple of those. So you talk about developing countries already overburdened with debt for basic needs. Will IMF, World Bank, etc., be willing to pre-arrange loans against disasters? This is a complex one that doesn't justify an easy answer. I agree. I think there's a strong awareness of that. The argument for those big development banks is partly that those are very concessional loans, so the charge is a lot lower than commercial rates, but I appreciate still it is debt. Ida touched on some of these new mechanisms, like a climate resilient debt clause, or what we sometimes call a pause clause, which at least allows countries to pause debt repayments when a disaster is declared, and whatever that trigger is, and to sort of balance there. I think one of the things we know about is the impact of a disaster. That the counter of that is that countries often have to take on huge amounts of commercial level debt to respond to that. So you know, that is another bit of that puzzle. But debt is a huge challenge in this space. And the other thing that I think you touched on that will be of interest to everyone is, will investors be interested in risk investment given frequency of risk? So, you know, shocks are happening certainly more frequently, potentially impacts greater. I think it's a challenge to the sector. So yes, they will still be interested, and certainly at a commercial level, it may be that rates have to go up if payouts increase. It may be that what is the severity of the shock goes up, and it may be that there is a credible call on donors to do more to try and offset some of those costs to make this viable. So that's a very live area and good one to touch on. Bukola Ejade, you ask, can international institutions give out loans to non-government organizations? Yes, they can in principle. I think it depends on the size of international institution. If we're talking the big financial institutions, that wouldn't be what they normally do. It's normally through governments, but that's where, you know, governments then need, when responding to a disaster, to work through you know, organizations that can actually provide the help on the ground, and that's where you know, there's a discussion to be had. And I apologize for the brevity of these given time. Louis-Jean Fagans, you're talking about access, particularly in the wake of Hurricane Melissa in Haiti. I think it's a very live challenge. So the sorts of things you're talking about in theory could be covered, but it would depend on arranging those instruments in advance. Jamaica, that was also, as you'll be aware, hit very hard by Hurricane Melissa, had a number of these instruments in place. And I know that the situation is a very different one there, but Jamaica has made a real virtue of the insurance and the bonds and other things it had in place, and I think is an interesting one to watch. I am almost finished and I am whizzing through these. Benassa Alu Lanwi, you asked, have we got documents on the financing? And I think Ida flagged some of the reading we have, which in turn will lead to other things. So that will be shared. Jonas Habimana, why risk transfer but not risk sharing? I think some of this is about linguistics. Risk sharing, so Ida touched on risk pooling, that can be where multiple countries come together to share their risk, essentially, on the basis that the same shock won't happen in the same countries all at once, but the responsibility for who then pays when that happens is still transferred to the private sector. So there's a mix of sharing and transfer there, but some of that is just the questions that, it's the language that we use. And you also ask, where's responsibility for disaster risk management? Is it the government, community, CSOs? I would say it's the sovereign duty of governments to protect their citizens, but I think we all recognize, there are decisions to be made there as to how funds are prioritized, even with willing governments, and we know there are contexts where governments are either unwilling or unable to respond. So some of this is around trying to force those discussions and actually understand better before a shock hits whose responsibility it is and what happens when there is a disaster. But it's as you'll appreciate, very sensitive. And last couple of questions. Justin Bazungu Matendo, I think if I finish with you asked multiple, I'll try and do them justice. So you asked what specific triggers can be set to activate prearranged finance for massive population displacements during disasters? Can all disaster prone countries benefit from the debt clauses we were talking about, or regional insurance? How can we articulate national reserve funds and prearrange funding from donors to avoid excessive dependency on post-crisis humanitarian aid? And how can these mechanisms be adapted? So again, there's the point on mass displacements or volcanic eruptions. Any one of those we could probably talk about for the next hour. Volcanic eruptions, I think there are mechanisms. The Red Cross and various Red Cross bodies in particular has looked both at cat bonds and some forecast-based finance for eruptions. So you may want to have a look at some of those. Mass displacements is more challenging. So UNHCR had a partnership with ARC in, I think, Malawi around natural disasters or natural hazards that triggered and affected displaced communities in settlements and host communities alongside them. That I know is different from new displacements, and that's politically challenging, particularly as mass displacements are often linked to conflict and all the political sensitivities there. But it is an area that lots of people are thinking about, including the World Bank. Can all disaster-prone countries benefit from climate-resilient debt clauses? They're mostly offered by the regional development banks, the multilateral development banks. So it depends which ones are offering them, but increasingly, and the sort of the creditworthiness, etc., of the countries, but those banks are increasingly offering these. And then I think your point on avoiding excessive dependency post-crisis, I absolutely agree. I think there's a very difficult line to walk between responsibility of the international community, particularly in light of things like loss and damage, as to where funding should come, but in the way that that should support national priorities and agendas and ownership, and how that is done. But again, part of the thinking with these mechanisms is to force those discussions and to understand essentially who's on the hook when stuff happens, to try and bring some of that into the light ahead of disasters, rather than trying to make decisions about that after the fact and in the middle of a crisis. I'm sorry, all of those answers are very brief and have still taken us over time, but I hope that that answers at least some of them, and let's think how we sort of continue this discussion. And Marcos, I'm sorry I've eaten into your time, but let me hand back to you to finish.
Jacqueline, please.
Thank you, Marco. Thank you, Chris. Just one question, Chris, which just came in the chat box. It is from our colleagues from DRC. So how pre-arranged funding mechanism could be adaptive to respond effectively at the conflict-affected zones? Yeah.
Brilliant, thank you. And I touched on this a little bit. I think there's probably a couple of different things here. So I suspect, and this is one of the things that actually we're hoping to dig a bit more into in this work and more broadly. So, you know, not to put the question back onto the asker, but we'd be delighted to explore some of these options. I think that sometimes there is a perception that if there is conflict or fragility, that these mechanisms don't work or are too difficult, or, you know, that we need stability and a regularly committed middle-income government to make it viable. I don't believe that's true. I believe there are different challenges, and some of that is around things like triggers. So how a particular trigger is measured may require sort of access on the ground to rain gauges or whatever else, you know, so how do you adjust that if there are areas that are difficult to access, whether for monitoring or for delivery subsequently? You know, how and where do you work with governments where you know there is fragility or conflict? But we know from, and particularly from sort of humanitarian actors, use of some of these mechanisms, and whether that's in the UN with things like OCHA, whether it's NGOs more broadly. So IFRC's done this, you know, smaller organizations like START do it, but it is definitely possible to do in conflict areas with adjustments, with an understanding of what that looks like. The big challenge, I think, is, so I would say that at the moment, most of these are about disasters and shocks. So it's natural hazards in fragile and conflict affected countries. We're not necessarily talking about prearranged finance triggered by conflict. So it's not necessarily a response to conflict itself. It's the impact of shocks on areas that are already sort of, the coping capacity has been reduced by conflict. It may be in the longer term, you know, some people are thinking about what a response more directly linked to outbreaks of fighting might look like and how that would work. But I think most of the work at the moment is around impacts of shocks in FCAS and how that works. But my argument would be, I think it's definitely feasible, it's happening, but let's try and use this work to dig into some of that a bit more, and to draw out some of our asks for what we'd like to see more of. I hope that answers.
Thank you, Chris. Over to you, Marcus.
Thank you so much, Chris. This is I think it is a great ending. I just wanted to again quickly remind you guys to please complete the survey. That's the way we are trying to capture your insights. Of course, all your contributions to the chat box will be taken into account. But in order to try to understand more in depth your understanding, your suggestions, recommendations for localizing DRR financing, we would like you to respond the survey. After that, and you will see one of the questions, the last questions, very brief survey. Please don't think it's going to be massive. But one of the questions is it is about if you would like to be part of a focus group after the survey, because as part of the analysis, we would like to identify in a more in-depth conversation all your insights, suggestions, recommendations. So please complete the survey, and if you're interested, we will welcome you in participating on the focus group. Then we will analyze all the results and try to put all that good experience from your side and all those recommendations in a beautiful report, and hopefully we will have another session in our global summit at the end of March and a beautiful roundtable in April as well. So that's basically the process of getting done this, I think, very brave initiative of understanding how to localize DRR finance from your perspective, from the local perspective. It's been beautiful to see so many people from DRC, Bolivia, Ecuador, Chile, Peru, Egypt, Haiti, Benin, Ghana, Madagascar, Nigeria, Mali, Cote d'Ivoire, Cameroon, Niger. So thank you all for taking part of this webinar. Thank you so much, Aida, Chris, Blossom, also Abdullah, Jacqueline, for organizing this beautiful webinar. And yeah, I think that's it for today. Sorry we took a little bit, some more minutes from you, but I think it was worth it. Thank you, everyone, and I hope we will see you soon.